Turning now to this morning's U.S. Bank Economic 360 with a look at where we are mid-year. It's hard to believe 2014 is half over. U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman joins us with a recap of the market in the first half of 2014 and where we may be going in the future. He's with Business Courier editor Rob Dahlmeyer in the studio. Mike and Rob?
Kelly, thanks. And I do eat my vegetables once a month, whether I need to or not, so I'm covered, I think, on that one. But we're here to talk about the stock market. 2013, as most people know, was really a great year. We're really right at the halfway point in 2014. How's it looking so far?
Well, you know, really it's kind of a mixed bag, if you will. I mean, when we consider the two main indexes that follow large cap stocks, the S&P 500 and the Dow Jones Industrial Average, we see a pretty wide disparity between the two so far this year. The S&P 500, which is the broader of the two indexes, really caught momentum in the second quarter and is up about 6% for the first half. So that's a little bit better than average, and I think, frankly, better than expectation. But on the other hand, you have the Dow, which is only up about 1.5% for the same time frame. So you have to remember that the Dow is a very narrow slice of the market, only focusing on a handful of blue chips. So what we can discern from the wide dispersion between the two is that high-quality blue chip stocks have really struggled to start the year, whereas some lower quality, more speculative stocks have actually done quite well.
And what does the environment look like as we head into the second half?
Right. Well, it certainly seems to be a very nice environment. I mean, we hear on an almost daily basis about the market hitting new records. The Dow hit 17,000 for the first time last week. But there's also concerns out there that the rally could be losing some steam. I mean, for one thing, we've gone almost 3 years now without a meaningful correction. And there's a lot of people pointing to that, saying not only are we due for a correction, but we're in fact overdue. And then there's also some seasonal considerations. We're just heading now into the summer months, which are notoriously slow for the market. And it's also a midterm election year. Historically, stocks have done very poorly heading up to that November election. So certainly the markets are at records, but you know, there's some headwinds out there as well.
Any predictions for the where we'll be at the end of the year? Maybe an exact number that the Dow will finish at so that I can race right out and make a lot of money?
I don't have that exact number because I didn't eat my veggies.
Come on, Mike.
But one thing that we can look for, I think, is in the coming weeks we'll be getting second quarter earnings reports. The market right now very dependent on these earnings and the fact that they continue to rise. So if there were some disappointing numbers in there, I think that could be difficult for the market. So we had first quarter numbers which were not very inspiring, frankly. A lot of companies were missing their targets, but we also had a lot of companies pointing to the poor weather that we had this past fall for missing their mark. So we don't have that excuse this time around. So if we get a second set of disappointing numbers, I think that could signal, instead of being an aberration due to the weather, a negative trend might be forming. So a lot of people are curious to see how these numbers come in. They're going to be very important, and depending on the strength of those, it really could set the tone for the rest of the year.
Well, at least we're talking about sort of normal ups and downs, hopefully, and not talking about how the 2008 crash is still hampering people's decisions. You know, who knows if that's true or not,
Exactly.
but it is fun to talk more micro and less scary.
Exactly.
Thanks for being here.
Thanks, Rob.